Well, stocks slipped last week with the S&P 500 notching its first weekly decline in four, while treasuries sold off across the curve, albeit with no obvious catalyst behind that move. But the move higher in yields did help the dollar to notch a 10th weekly advance in the last 11, as the BOC, the SNB, and the ECB all delivered interest rate cuts. Looking ahead, the last proper trading week of 2024 awaits, and it's a biggie that lies ahead with 5 G10 policy decisions due, including, of course, the FOMC on Wednesday, plus a packed UK data docket and plenty of releases from elsewhere as well to keep us all busy as we move towards Christmas. So there's plenty for us to discuss on the final trade-off of 2024. Without further ado, let's crack on with the show. So plenty for us to discuss. It was a busy week last week. It's another busy week ahead, and joining me to try and make sense of it and navigate everything as always in his finest festive wear is Ryan Littlestone from Forex Low Live and Forex Analytics. And Ryan, I didn't want to be left out, and I've brought myself a little hat of my own that I could wear on the show this week. There we go. Let's get that to stick up a little bit more. So I will be more than happy to join you in my own festive outfit.
Oh, you said you would get something was coming, and yeah, that's right up your alley, mate. Bar humbug.
Indeed. But setting the humbugness aside, I mean, we do have plenty going on in the markets. I mean, it was a busy week last week, and well, I mean, there's everything going on this week, isn't there?
Yeah, just the 5, I think, central banks this week.
Yeah, well, 5 in G10. There might be a few more lurking in emerging markets that we haven't thought of, to be completely honest with you.
Yeah, exactly. But this happens every year. We get this last week before the holidays, and you have to keep your nose to the grindstone, and it's going to be a busy one.
It absolutely is. I'll tell you what, it's also going to be a bloody hot one because this hat is rather warm on the top of my head. But without further ado, let's crack on with Topical Thunder. See, that was a surprise worth waiting for, wasn't it? I don't like to disappoint you. Right, speaking of disappointment, the Fed, they don't like to disappoint markets either. And we go into the FOMC meeting pricing around a 95% chance that the Fed deliver another 25 basis point cut on Wednesday evening, which would take the target range for the Fed funds rate to 4.25% to 4.5%, and would, of course, bring us to a total of 100 basis points worth of easing this year. If the market implied probability of such a move was not enough to bully the Fed into it, which, let's be honest, it is, the data also helps to support the idea that they will deliver another cut. Unemployment rose to 4.2% in November, just off the cycle highs that we saw in July during the middle of the summer. And then inflation rose broadly in line with expectations in November at 2.7% on the headline CPI metric and at 3.3% on the core number. Now, I think the key focus going into Wednesday's meeting is going to be the summary of economic projections, and primarily the dot plot within those projections. Of course, the current 2025 median dot, well, that points to a further 100 basis points worth of cuts next year. Now, I think we're going to see the dispersion of those dots tighten quite a lot. If you look at the dot plot from September, the most dovish expectation was that rates would fall as low as 2.75% next year, which I think is very, very ambitious indeed at the moment. But I think it's going to be tough to see the actual median expectation move higher, because if I've done my maths correctly, it would take 5 of those who are at the current median level to move their expectation higher for the actual median dot to move higher. So I think we will get a little bit more of a hawkish message, but whether that median dot actually moves is a slightly different question. Other parts of the summary of economic projections, well, we may as well just cast them aside and ignore them, because they're probably going to be broadly unchanged from the projections that were issued in September. And they're also conditioned on a set of fiscal assumptions that within the space of about 4 weeks will change dramatically as President Trump is inaugurated and comes into the White House with his own fiscal policies. Now, of course, this means that Chair Powell is going to have a very, very delicate balancing act at the post-meeting press conference. Of course, it's December. The Fed is the last big risk event of the year, and I think he's certainly not going to want to rock the boat too much. But But at the same time, Powell is going to want to try and build in some optionality and some flexibility to deliver a much slower pace of easing in 2025. And ideally, I think, keep the door open to a potential skip at either the January or the March meeting, or perhaps even both, if upside inflation risks really do start to emerge.
Yeah, I think there's 2 or 3 key points on this one. As you say, the inflation side of things, again, is a credibility issue for them. If we see inflation rising again, and we've seen it over the last few months, if that keeps going, then that puts a question of whether they're going to get to target or not. Then begs the question, have they done enough with keeping rates tight enough or not? So that's one side of thing. The other side is obviously, as you say, Trump policies. A lot of banks, a lot of countries are sort of taking a little bit of a pause because they want to see what's going to come in January. Are we going to get hit by tariffs? What are the policies going to be like? So in one sense, then we're going to get potentially a bit of a can kick from the Fed. Meanwhile, the economy is ticking along nicely. So it is a fine line that Powell's got to walk for this one. How he spins it is going to be, the key to watch. As you say, I don't think much is going to change for the forecast, but I agree we're going to see a tightening up of those dots closer to the median. I think the market still might just want that confirmation that a pause is on the table. And if it gets that, we're going to see dollar and yield rallying again.
Yes, you would certainly expect so. But, certainly before, but also after the Fed, it's a busy week of economic data as well, isn't it?
Yeah, very much so. Really is the last chance for trading some of this data, particularly ahead of the Fed and some of the other central banks. Now, while the market might be set for a 25 pip cut, that doesn't mean the dollar isn't going to move around on the data points we have before the FOMC. Before you see this, we would have already had out the Empire manufacturing data and the S&P PMI coming out. They don't usually come out on the same day, but it seems like everyone wants to cram it in before the Fed and the holidays.
Exactly.
And on Tuesday, we get US retail sales, which will cover the Thanksgiving and Black Friday shopping periods. Now, sales are expected to rise 0.6% for the headline retails and 0.4% for the ex-gas and autos. Now, this data could be the biggest mover for the dollar before the FOMC if there's a big variation. After that, we get industrial production and then the NHAB housing market index. That's not usually a big mover, but the market, I think, is going to be laser focused on every sector before this FOMC. On Wednesday, we get more housing data, starts and permits. And again, if there's a big variation to expectations, the market will jiggle around those last-minute rate cut expectations. To send us into the holiday week, Friday delivers the PCE. Now, that shouldn't be too far out from what we've seen in the CPI data, but it will be data that maybe raises some questions post-Fed, and depending on what the expectations are. Usually from the PCE data, it's not too far from the CPI data. So while I'm not expecting any huge moves on this data, again, the time of the year may see some jumpier than normal moves. So got to be careful as always this week.
Yes, absolutely. Very well said. I think the retail sales print is going to be pivotal. Indications are that spending was pretty solid over that Black Friday, Thanksgiving, Cyber Monday period. Also, of course, there's that old adage of never betting against the US consumer, which serves most people pretty well. The one thing I would say about PCE is I wouldn't be at all surprised. Well, firstly, actually, the CPI and the PPI figures, if you extrapolate those, they point to a relatively soft PCE number. The other thing is I wouldn't be at all surprised if actually Powell at the press conference on Wednesday gives us a pretty strong hint as to where that number is looking likely as falling, or even just gives the game away entirely as he has done in speeches before and said, we expect it at X. And then funnily enough, it turns out to be at X. So I think that's obviously one to keep on the radar. But for me, it's retail sales that is the big risk. If they are a little bit soggy over that Thanksgiving period, then that could really start to spook participants. And I think we're going to discuss this a little bit later on. But if we do see markets get a little bit jittery, are there going to be people wanting to sort of step in and catch that falling knife at this time of the year?
Yeah, and it's important to remember with these Thanksgiving sales and Black Friday sales that a lot of it can be tilted towards the technology side of things. So, you're not getting many people going out and buying a lawnmower on your Black Friday sale. So, while you may see, and we saw good numbers from Adobe's reporting the few days after, it's maybe the bricks and mortar stores that may see some weakness, but that all comes out tomorrow, and we'll know from then.
Indeed, we will. I'm going to be honest, I'm not sure many people would buy a lawnmower in November, whether there's discounting or not, but that's probably a subject for another day. Moving on, somewhere you definitely don't need a lawnmower at the moment is the UK, and it's a busy week. That was awful. It's a really busy week here in the UK this week. We've already kicked things off. Well, actually, the back end of last week, we had the October GDP figures, which were pretty dismal. The economy contracting by 0.1% on a monthly basis. The second straight monthly contraction in GDP. And then we've kicked off the new trading week with a little bit of a mixed bag of PMI surveys. The manufacturing index, that fell to an 11-month low, but the services index rebounded back above 50, albeit only marginally so. So a little bit of a sort of mixed bag there. The rest of the week here in the UK is very, very busy indeed. To take things day by day, tomorrow, Tuesday morning, just before you watch this show, we get the latest unemployment data and earnings data, of course. Unemployment, that's expected to have held steady at 4.3% in the 3 months to October, but of course is very, very unreliable given the ongoing issues with the ONS and their labour force survey. Earnings, meanwhile, growth in average weekly earnings is expected to quicken to 5% on an annual basis, up from a prior 4.8. Still very, very sticky. And what we're likely to see is the start of those above inflation public sector pay rises beginning to feed into the data, which will also likely impact the November jobs figures that we get out early in 2025. But again, whether you've got those in there or not, that's clearly a rate of earnings growth that is incompatible with a sustainable return to the 2% inflation target. Speaking of inflation, we have the latest figures due on Wednesday morning. Headline CPI, that's seen rising by 2.6% in November. That will be up from the 2.3% prior. We're also expecting core inflation to tick higher to 3.6% for a prior 3.3%, and services to have held north of 5% once more. All of those figures moving in the wrong direction, all of them pointing to price pressures remaining pretty stubborn, and none of them pointing towards the BOE having the room to cut further at this moment in time. Hence, we would fully expect on Thursday the BOE to hold bank rates steady at 4.75%, likely to be an 8-1 vote with Dingra again in favour of a 25 basis point rate cut, but the MPC should reiterate their gradual and data-dependent approach to removing policy restriction. You'd expect the statement to be broadly a copy and paste of that delivered after the November meeting. And then lastly, on Friday, just to keep us all busy as we move in towards the festive break, we have retail sales figures due from here in the UK. Sales expected to have risen by 0.5% on the month in November. And of course, that does not cover the key festive discounting period here in the UK. The ONS survey week is just before Black Friday. And we also get the latest public sector borrowing figures in the UK as well. I wouldn't normally mention that, but October's data was the second highest October on record since those records began back in 1993. And of course, the fiscal backdrop here in the UK is very, very precarious at the moment. So plenty for market participants to get their teeth into here in Blighty this week.
Yeah, and the Bank of England and Bailey, as usual, not far from that middle ground between a rock and a hard place. What have we seen? The PMIs, employment, the worst in 4 years. Prices rising again, input and output prices. CPI expected to go up, wages expected to go higher. Then we get a negative growth. It's not a good cocktail. And really, this is one of those situations where what does the bank move on? Does it move on the inflation side, i.e. stand pat, or does it move on the weakening economic side and cut rates? So I'm really in the middle for this one. I think the vote might be a bit closer than 8-1, but you never know with these clowns. And that's a technical term. So yeah, it's again, as I say, rock and a hard place. One side there's higher prices, and we always knew that that prices were going to be stickier in the UK more so than anywhere else. And now we're seeing growth dwindling and going down, and the government crashing the economy, as they like to say of their previous government. So good luck, Mr. Bailey. I don't know what you're going to do, and I'm going to sit here with my feet up when you do it.
Well, I think the most likely thing for the BOE is that they focus on inflation primarily, and then they end up being forced to cut because and cut quite aggressively, probably in the sort of second or third quarter of next year, because the demand side of the economy is just had an absolute crunch, and that in turn brings those persistent price pressures out of the system. But of course, only time will tell on that one. Moving away from the BOE into the BOJ, where we've had 7 or 8 sources stories for this meeting by this point, have we?
Yeah, I think it's a record for this year how many we've had, and they've all come out one after the other, and the market got bored after the second one. But looking at the Bank of Japan, and they're feeling as nervous as a Christmas turkey right now. In the last week, as Michael said, I think I've counted 4 of those sources pieces about them looking to maybe hold rates this week. And that comes even when UAID himself has said that the economy is apparently on track to meet all their forecasts. So the big man himself has said that they're doing enough to potentially hike. And now we've got these stories that they might hold. We know that they're a very cautious bunch. But right now they seem to find more reasons to hold back than to actually hike, even when the data says that they should be able to hike. And those outside forces, like possible Trump policies, seem to be a bigger part of their discussions than any other central bank. Now, the broad expectation is that they do stay on hold at 0.25% this week, and I really fear for the yen if they do. The sources stories have already seen the yen weakening, which, oddly enough, recently, UAID has made it one of the possible conditions for hiking, as FX moves are now a big part of their consideration. So if the yen weakens too much, they might hike on the back of that. So they've sort of made a rod for their own back here. Now, if they do decide to hike, the question is going to be whether it's a small one, like 10, 15 basis points. That will obviously catch the market on the hop because it's expecting unchanged. But I don't think any yen gains on the back of that will last, as it will look like a pretty cautious hike. If they do surprise with a 25, we will see some strong yen gains. But if the forward guidance after that indicates maybe a protracted hold until Trump comes in, until they see the next wage deals in spring, again, I can't see any yen gains lasting too long. So really, I don't see any real paths to leading to a convincing long-term bout of yen strength. But as we remarked last week, year-end can paint a false picture of that. My advice would be to note the BOJ stance this week and keep that front of mind when judging any year-end moves and what the yen does after that.
I think that's very sage advice. I would note 2 things on the BOJ. The first, well, actually 3. The first is that these outside factors do seem to be having much more influence than we really expected that they would, which is quite surprising. The second is that I think their window to tighten policy further is rapidly starting to slam shut, given, we're talking about the Fed having done 100 basis points worth of cuts this year, probably another 25 in the first quarter. The ECB are probably going to have done 150 this cycle by the end of Q1 next year. The BOJ are going to struggle to hike further in that sort of an environment. The third thing I would say is for anyone who is laser focused on the BOJ and the yen, Merry Christmas to you all. The 25th of December, also known as Christmas Day, Governor Ueda is going to be giving a speech in front of a very influential council of economists and economic advisors in Japan. It's almost like the Japanese version of Jackson Hole is one way to sort of liken it. And this is a venue that BOJ governors have in the past used to announce sort of policy pivots or upcoming policy shifts. So I wish I was making that one up, but maybe it's not going to be a sort of season of peace and joy for any yen traders out there.
Yeah, as long as it's not overlapping the King's speech. I don't know which one I listen to otherwise.
Well, you'd have to get 2 screens, won't you? Right, moving on to some charts, and that's the setup. That is a recipe for dodgy, weird, violent market moves, by the way. If UADA does surprise with something on Christmas Day, all bets are off where dollar yen could go. Anyway, we're going to talk about that in a second. I want to talk about the S&P first. It was first weekly loss in 4 for the S&P last week. Maybe a bit of profit taking coming into the end of the year. Maybe a bit of rotation going on under the hood as well. The Dow and the Russell both softer, while the Nasdaq rose to fresh record highs. So perhaps some more buying coming in to the tech sector. We are, of course, still just shy of record highs in the S&P as well. But I think, as we alluded to earlier on, the key question now is there still conviction out there to be coming in and buying the dip when we've got probably about 10, maybe even less than 10 trading days left in 2024, and when the market is up 27, 28% year to date. That said, the bull case does remain strong for a fundamental perspective, and this time of year does have a favorable seasonal dynamic as well. But I do just think perhaps a little bit of caution is required. The market has come a very long way this year. Frequent viewers will know that I have been very bullish for most of this year as well. And I think this is one of those times where you kind of sit there and go, actually, is this worth chasing for another % or another 2% when the market is up solidly year to date? And I think most participants will probably say, actually, no, it's not. Let's just put our feet up and come back in 2025.
Except for me, I'm currently running a buy stop through those highs at 61.
You have to be different, don't you?
Well, the reason is I think we're just, like we often see in markets when we got a big meeting coming up from the Fed, the market just tends to take its foot off the gas. Yes, we may have had a losing week last week, but we're not too far from those highs, and the dips keep getting bought. And I'm just getting the impression that the market is just waiting to get over this hump, make sure there's nothing too untoward. Yes, he could go at 25 and say we're pausing, but that's going to be against the backdrop of a real solid economy, which is good for stock. So as we've known throughout the last decade and ever since we've been doing this show, there's every reason why stocks keep bouncing until something really big happens. And I doubt that's going to be this week, touch wood. I see further upside and possibly happening, if not before, but after the Fed.
Yes, potentially. I know we've been doing this show for a while, mate, but please tell me it doesn't feel like a decade. Bloody hell. Right. Moving on, we're going back to the BOJ, I believe.
Yeah, and no, it doesn't feel like a decade, mate, but looking at your hair, the way that's receded over the last couple of years, it might have been about 30 years. But
I might just keep the hat on every week now, even if it's not Christmas.
Yeah. Well, I might get a late Christmas present for you off Amazon, a little syrup or something. You can stick it in the old penalty spot. But anyway, moving on before I get in trouble. We're going to look at dollar yen today because we do have both central banks this week, so it makes sense to do a bit of prep work in dollar yen. There's double upside risk for this pair, really, with the Fed possibly being more undovish and the BOJ still finding excuses not to hike. I'm going to keep this one fairly simple as the levels are pretty clear. We held the 152 level last week after the move up through it, and we've also been running along the top of the daily cloud for the last couple of weeks or so, and we haven't actually been able to spend a day below it. So that's become a real support point down there, and that daily cloud has moved up to that 152 level right now. So that's a nice bit of solid confluence at that level. Top side, 155 has been a significant level, a bit like the 152, as has 157 above that. Now, I know these levels are quite far apart, but given the volatility we might see and that we've seen previously in this pair, I always tend to focus on what I think will be the bigger, stronger, more key levels on a chart. For me, I'm more inclined to be a dip buyer than a rally seller this week. Obviously, central bank decisions notwithstanding.
No, I would be inclined to agree with that. And I think dollar yen, as you say, the levels are very, very clear on this one. And at the moment, we're sort of trapped between two of those significant levels. So I think this is very much a case of wait and see what the Fed, firstly, and then the BOJ, of course, have to say, and then react to either the 152 or the 155 figure, whichever comes first.
Yeah, exactly. Don't need to be a hero for this one. Just sit back and let the levels come to you.
Certainly. And if it were me, I would not be holding that on Christmas Day after what we said earlier as well. Right, moving on. Cable. Cable Bears got a bit of a Christmas present last week. It was a dismal end to the week on Friday. Obviously, we had those GDP figures out of the UK, the second straight monthly contraction. And I think what's more worrying is not the fact that the economy shrunk by 0.1% in October, because let's be honest, that's a rounding error in the grand scheme of things. The point is more, this was before the budget. This was the pre-budget uncertainty and the government talking the economy down that tipped the economy into that contraction. What we're now dealing with in the Q4 and then Q1 2025 data is going to be the actual impact of that budget, which of course raised taxes by nearly 30 billion quid, and also those significant national insurance changes, which will come into effect from April. So I think the risks in terms UK economic outlook are still tilted firmly to the downside. The fundamentals of the pound are still pretty bearish in my view. You've got a real risk now of stagflation coming in, particularly with the inflation metrics this week likely to show underlying price pressures remaining very, very stubborn, as we alluded to. And as we were saying earlier, I think that's going to keep the BOE hawkish, and actually hawkish for the wrong reasons, because the BOE in an ideal world would want to be easing more to try and support growth, but they can't, because we're still dealing with a really significant inflation problem. From a technical perspective, things are also looking quite promising for the bears. Price failed last week around the 128 figure and the 200-day moving average just above that, and we're now trading below prior support at 126.75. So it does look like we could be on a bit of a one-way train back towards the 125 figure, particularly if we get a more hawkish than expected FOMC on Wednesday night.
Yeah, I'm not feeling too good about the pound at the moment. You know me, I like to play Euro Sterling quite a lot, and but cable, yeah, the Fed is still looking pretty bullish, and the US economy is looking bullish. We seem to be taking it day by day, shooting ourselves in the foot with what the government's doing. So I don't see any real reason, again, by maybe some year-end flows, why this would rally significantly. So if I do see a rally into year-end, maybe we tap up 128, 129, and it looks like an outlier move, then I'm probably going to be looking for the short side in this one.
Yeah, and actually that's a decent strategy if folk are looking to be at their desks into the end of the year. Those moves that are kind of out of line with the fundamentals, they're the sort of moves that actually could be ripe for a fade either into the end of the year or in the early part of 2025. That's the sort of trade that, if I was going to be around into the end of the year, that's the sort of moves that you really should be looking for, I think. But anyway, moving on to the fixed income space.
Yeah, looking at 10-year notes, US 10-year notes again, because the yield yo-yo is back. From hitting 4.5% just over a month ago, then we saw a dip and we bounced back from the 420 level. The higher for longer expectations of the Fed are helping yields mostly in the longer end. Now, that 450 level comes in around the 109 level in price terms, and that's been a solid support zone since mid-June and even beyond then. Now, we're in another situation where the market may be assessing whether this time the Fed might really need to pause on policy, and inflation may have stopped heading towards target and may even be creeping up. Now, last time we were down here, I said that might turn into a bit of a solid place to bounce, but coming back again to this level relatively quickly, it's not something I like to see in price action. The old saying goes, a level is a level until it's not. So while it might be decent support, I'll treat it with a bit more cautious this time around.
Yes, I think you're absolutely right. Obviously, this is a price chart. So for those wondering why that's moving down as yields move up, that is why. I would say that actually the moves that we saw last week were very strange, to be completely honest with you. I mean, there were no, massive catalysts out there that would have moved the 10-year yield 20 odd basis points and the 30-year yield 30 basis points over the last 5 days. So again, that could be, just going back to what we were saying earlier, a little bit of an example of these odd moves into year end that the market may look to fade, although there are a few catalysts still out there for the fixed income watchers. Obviously the Fed this week, PCE Friday, and then actually Christmas week itself. I think we've got a 2, a 5 and a 7-year auction out of the United States. So if anyone is going to be working over Christmas, it's the Treasury participants, I think.
Yeah, good luck to them.
Well, yes, quite. Right, let's get on to our plays of the day. Right, my play of the day this week is to do absolutely nothing, as it was this time.
No change there then.
Sorry, mate.
No change there then.
Well, yeah, all right, yeah, very funny. As I said, this time last year, it is, of course, the last proper trading week of 2024. It's also the start of time of year where things get a little bit strange and a little bit funky in financial markets. You certainly won't be going to make your 2024 this year, but I think it would be very, very easy to break it. Market conditions are already getting very, very thin. Yes, like my hair, before anyone else gets that joke in. And I think things are only going to get thinner after the FOMC and when Powell wraps up his press conference on Wednesday. So my trade this week is to go and take some time off the desk, put my feet up, have a well-earned break, and I think most people out there should probably do the same thing, apart from Ryan, who wants to try and trade gold.
Yes, exactly. I can only echo your sensible words, really, but I just can't help but squeeze, one more play of the day before we break up. Gold's having one of its bearish moments, so this trade I'm looking at is going to be a long down into support around the 2620s. Now, like the prior price action, I think you have to account for possible extensions, perhaps down to the 2600 figure. Below 25.89.90, the trade is wrong. So I'm looking at this zone that I've just marked up in green. Now, considering that's over about a $20 price range, I'll be looking to split the trade up over both those levels, 2620s and 2600. So going smaller and a bit wider on the trade. If I'm not in anything come Thursday, though, I won't be taking the trade at all. And I just want to add to Michael's sentiments as well, and to thank everyone who's come and watched us from the show here. And have a happy Christmas.
Indeed, yes, that is all that is left for us to say. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, not just today, but every week throughout the last 12 months or so. Thank you also to our producer, Kyriakos, when he's bothered to turn up, and his stand-in, Raf, for bringing the show together brilliantly throughout the year. And thank you also to watching and for all the comments and various interactions that we've had over the last 12 months. Hopefully you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well and let us know your thoughts on markets at the moment, and maybe even your views going into 2025. We are now taking a bit of a break here on the Trade Off. We'll be back in mid-January. So in the meantime, have a very Merry Christmas, a Happy New Year, and we will see you in 2025. Goodbye for now.